So now, as we're thinking through, we're working through the financial order of operations to uncover things to do before the end of the year. Number 4, we want you to maximize that tax-free money. That's right. You heard it right. The money that you will not have to pay income tax on. Brian, you say these are the favorite dollars inside of your portfolio.
Yeah, we get really serious about this because think about it, guys. Our government, they like taxing us. And it's very few things that they create legal loopholes where on purpose they've designed it as part of the process is we're going to give these benefits of tax-free growth. You have to ask yourself, why would they do that? The reason they do it is because it's good for the public. They want you to have healthcare covered. They want you to have retirement covered. So they have incentivized through the tax system to say, hey, we're going to give you tax-free growth, but we're going to limit who can contribute.
Yep.
We're going to limit how much you can contribute. So you can quickly realize, hey, if they're going to create these huge benefits but put all these restrictions, I better get in there and maximize where this free, tax-free money is actually at.
So let's talk about the first account where this is available. It's a health savings account. So one of the questions that we want you asking is, okay, was I eligible? Was I in a high deductible plan last year that makes me eligible to contribute to a health savings account? If the answer to that is yes, did I max it out? For 2025, the max limits are $4,300 for single contributors and then $8,550 for family contributors. So that's the first question. Did I take care of 2025? But now, as we move into 2026, as we think about next year, open enrollment is likely coming up. So we want you answering the question, okay, what insurance plan makes the most sense for me? Should I go with the high deductible plan that's available, or might there be another plan, a subsidized plan, a Cadillac plan that makes more sense? And you may be asking the question, okay, well, how do I decide? And we think that there's a math calculation you can do. What you want to do is you want to line up 2 columns and you want to compare the premium costs, how much each plan costs. You want to then make an estimation of what your out-of-pocket costs would be with each plan. With a high deductible plan, it would be hitting that deductible. With the other plan, it would be your co-pays and co-insurance and those sort of things. You then want to factor in any employer incentives. Is your employer willing to put money into the HSA for you? And then lastly, we want you to factor in tax savings. You add up those 2 columns and you figure out, okay, for this next year, my best guess is that this plan makes the most sense for my family. And you ought to reconsider and reanalyze that every single year at open enrollment.
Look, guys, this is one of those, don't skip doing your homework. I know that there's this tendency once you graduate high school, college, whatever your higher education is, homework is like, well, I'm done with that. No, there's still going to be a lot of math you have to do in life. And this is one of them because as you're growing your family, that's going to be a different year than the years that you're, right fancy free out of college and you're not worried about, growing a family or big life decisions. You've got to make sure that you're taking account. This is an annual enrollment. That's why I like doing these shows is typically the most automatic, the most employers have around November, you to make these choices. Don't sleep on that. These are big opportunities. You can jump in, you can jump out. You need to make sure personal finance is very personal, that you're not missing out on any opportunities to personalize that employer opportunity to maximize your financial life.
And remember, funding the HSA is just the first part of the equation. We want you to be not like the 85% of folks who just use it as a slush fund. We want you to be like the 15% of folks that actually put that money to work. So make sure you get that HSA funded and then you let those dollars grow. So that's the first account, health savings accounts. There's another type of tax-free account that we absolutely love, and that account is a Roth IRA.
Yeah, remember how I was talking about how the government has restricted how much you can put in? These Roth IRAs are so valuable. This is going to be your gateway into tax-free millionaire. Can you imagine? You want to get me excited. Thinking about having a double comma 7-figure portfolio that the government's not going to tax, and I'm even going to potentially be able to pass it on to my heirs. Guys, this is the good stuff here. So good that the government restricts it. $7,000 annual contribution. Yes, if you get to be 50 and over, you can do an extra $1,000, but they're pretty much capping you around $7,000. There's phase outs. Once your income, you make too much money, $236,000 for married filing jointly, $150,000 for single individuals. Pay attention to these things. There's also this little known thing called, or well-known thing, Roth conversion strategies or backdoor Roths. We'll talk about that, but it's one of those things. Don't sleep on Roth IRAs. They're huge opportunities.
Now, maybe you're someone who you said, guys, I know I love Roth IRAs. I've been doing a Roth IRA, but man, I didn't know this year was going to be quite as good as it was. Or maybe my spouse went back to work this year. Maybe I got a bonus that I wasn't expecting. And all of a sudden, I recognize that I'm going to make too much money this year. I was ineligible. That's okay. These things happen. But what you want to do is before you file your taxes, before you get into the next year, if you can fix it now, you're going to make your life a whole lot easier. You need to go contact your custodian and say, hey, I was making these contributions. I put money in my Roth. I was ineligible. I need to go undo that contribution. I want to distribute that contribution. It won't be taxable to you unless there are earnings attributable that have to come out as well. But you can then pull that money out, undo it, and look at one of these other strategies like potentially a backdoor Roth IRA contribution.
Yeah, we've done tons of content on that. We're trying to give you the ins and outs for year-end planning, but definitely if you make too much money for the Roth, make sure your account structure is right. This is a measure twice, cut once, but definitely look into backdoor Roth contributions too.
Okay, so once we've maximized the tax-free accounts, we've put the money in the HSAs, we've put the money in the Roth IRAs, now we get to go back to our employer-sponsored account. Now we get to go back and hit that maximum salary deferral limit, either in our 401k or our 403b or our 457 or our simple IRA, whatever room we still have to max out. We want you to say, okay, between now and the end of the year, is something in my life going to happen that's going to allow me to hit that salary deferral threshold?
So I think it's important. Let's go ahead and throw the numbers out there so people know what they're dealing with. If you're in a 401k, 403b, all those, the alphabet soup that Bo threw out there with the numbers, $23,500. That is your 2025 number. If you're 50 and greater, it jumps up over to $31,000 because there is a catch up, and there's a unique thing that just kicked in. There's what's called a super catch up for those that are 60 to 63. Pay attention to these unique opportunities because the government, once again, is trying to incentivize your ability because it's good for society for you to have money in retirement. So they're trying to give you these little one-ups so you can go in there and maximize your financial opportunities.
And we want you to recognize that our tax code it's a little nuanced, and there are things that can have big impacts even if you're just over by $1. So one of the things we want you to think through is, okay, if it's in my power to be able to max out these salary deferrals before the end of the year, will this open up some other tax opportunity for me? Is this going to move me into a lower tax bracket? Is this going to potentially make me eligible or available for a tax credit that I was not going to have access to otherwise? If you do not know how to do that, if you don't know how to run a tax projection, if you don't understand how the tax form works, consult with a tax professional and say, hey, can you give me some insight? If I were to max out my 401k or max out my 403b, are there things on my tax return that would change because of that? And you might be amazed to find out that there are things that could be impacted just by doing an extra $3,000, $5,000, $10,000 into these retirement accounts.
Well, and think about this. If you're a person that gets a big year-end bonus, guys, I've helped employees and even, in some of our employees where we've loaded up some of those year-end bonus money goes to max out these retirement accounts. If you're self-employed, and you haven't researched solo 401ks and other unique planning opportunities, because if you want to know legal loopholes that the government incentivizes you to do, employer plans are great. So take advantage of doing a little bit of research to save yourself tons of money on taxes.
Now, as a quick aside, because we get this question all the time, a lot of people say, guys, I'm saving 25%, but I'm not maxing out my 401k based on my income, based on where we are. We're doing all the stuff. We're doing the Roths, me and my spouse, and we're doing the HSAs and hitting the family max, and we're putting money into our retirement accounts, but we're not maxing them out. Does that mean that we still need to max them out? Well, if you're already at 25%, not necessarily. If you're at 25%, we then want you to move to step 7, hyperaccumulation, and begin answering the question, how am I actually going to use these dollars? When I'm saving, when I'm building, when do I think I'm going to need to be pulling out? And when you answer that question, you're going to know then, okay, do I need to max out, or should I open up an after-tax account? Should I start saving into that tax bucket at this stage?